Welcome to AI Unveiled.
Picture this: a bold AI company hitting $100 million in annual revenue in mid-2025, yet raising $500 million at a $5.5 billion valuation, banking on hype and unfounded economy of scale. That's Cohere, not imagination. Now scale up. Imagine a firm pulling in $200 million ARR, projecting $600 million next year, and in talks to raise capital, valuing it at up to $30 billion. That's vast data, infrastructure darling of the AI gold rush, growing faster than its financials can justify. Both are poster children for inflated AI valuations, trading margin discipline for speed to unicorn. And then there are the shadow plays. Startups generating, say, $40 million in revenue, raising $75 million at a $1 billion valuation, but eking out just 10% gross margins, splurging half on idle GPU leasing, effectively reselling compute at a markup with no moat. Welcome to the AI gold rush, where buzzwords raise billions, and product market fit is optional. Let's peel back the pitch decks and find out who's actually building and who's bluffing their way to a Series C. This is AI Unveiled, where we cut through the hype to reveal the reality behind today's most talked about AI trends. I'm Asif Waliuddin, and today we're diving deep into the inference provider phenomenon, the companies racing to democratize AI access while grappling with economics that would make even seasoned tech veterans sweat.
Segment 1. The billion-dollar mirage.
Let's start with the numbers that have everyone talking. Modal, a New York-based inference provider, is reportedly in talks to raise $75 million at a $1 billion pre-money valuation. Drawing from over 2 decades in technology leadership, I can tell you that billion-dollar valuations used to mean something very different. But here's where it gets interesting. As of March, Modal was generating $3.3 million monthly, roughly $40 million annualized. Compare that to Base 10 at $50 million, together AI at $150 million, and Fireworks AI at over $200 million in annualized revenue. The growth trajectories are impressive, but the underlying economics tell a different story. From our vantage point at nxtg.ai, where we're tracking the pulse of the AI industry in real time, one thing is crystal clear. There's a growing disconnect between sky-high valuations and sustainable business models. These aren't your classic SaaS plays pulling in 80% gross margins. What we're seeing are infrastructure resellers, companies riding the AI wave while operating on razor-thin 10% to 50% margins. And that's being generous. They're locked in a race to the bottom, competing in a rapidly commoditizing market, all while burning venture capital to mark up someone else's compute. Let me give you a historical perspective. When AWS launched EC2 in 2006, they faced similar margin pressures. The difference? Amazon had the scale, owned the infrastructure, and could afford to operate at lower margins while building toward profitability. Today's inference providers are middlemen. They're renting GPUs from the same cloud providers they're competing against. The fundamental question investors should be asking isn't, how fast are they growing? But what's their path to sustainable unit economics? Because in infrastructure, scale doesn't always equal profitability.
Segment 2. The margin trap.
Let's talk about the elephant in the server room: margins. Modal's reported 10% gross margin isn't an outlier. It's a symptom of a deeper structural challenge facing the entire inference provider ecosystem. Here's the math that keeps CFOs awake at night. These companies must maintain 40 to 50% of their GPU capacity idle to handle demand spikes. When your primary cost, GPU rental, runs 24/7. Whether you're using it or not, your utilization efficiency becomes critical. At 50% utilization with a 10% markup on cloud provider rates, you're essentially operating a charity. Grounded in the real-world deployments we're leading at nxtg.ai, I've seen firsthand how inference costs can spiral out of control fast. We hear from companies who watched their monthly AI bills jump from $5,000 to $50,000 almost overnight, and not because their user base exploded. The culprit: inefficient resource allocation. It's not just about scale, it's about control. And right now, most companies are flying blind, burning cash on every token. Consider Fireworks AI's $200 million annualized revenue. Impressive, right? But they're likely spending $120 to $140 million on GPU costs alone, leaving $60 to $80 million to cover engineering, sales, support, and hopefully profit. When your customers, companies like Cursor and Perplexity, are themselves racing to optimize costs, you're in a margin compression cycle with no clear exit. Traditional cloud providers like AWS, Azure, and Google Cloud can afford lower margins because they own the stack. They manufacture at scale, optimize at the silicon level, and amortize costs across millions of customers. Inference providers are playing a different game with someone else's equipment. The companies that will survive this shakeout are those building differentiated value beyond pure GPU access. Think specialized model optimization, industry-specific inference stacks, or proprietary acceleration technologies. Pure reselling is not a sustainable strategy.
Segment 3. The strategic reality check.
Now, let's separate the hype from the strategic reality. The inference provider space isn't inherently flawed. It's serving a real market need. The question is, which business models will create lasting value? Through ongoing conversations with startup founders and tech innovators, I'm seeing 3 distinct strategic paths emerging. Path 1, the optimization play. Companies like Modal, focusing on developer experience and rapid deployment. Their value isn't just GPU access, it's infrastructure abstraction. When a developer can deploy a model in minutes versus days, that time savings justifies premium pricing. Path 2, the specialization strategy. Providers targeting specific use cases. Healthcare, financial modeling, autonomous systems. These verticals have higher willingness to pay and stickier customer relationships. Path 3, the platform evolution. Moving up the stack from infrastructure to full AI application platforms. This is where the real value creation happens, but it requires significant R&D investment. Here's what we're seeing in enterprise deployments. Companies initially choose inference providers for speed and simplicity, but as their AI workloads mature, they inevitably move toward cost optimization. The providers that survive are those offering clear migration paths to more efficient architectures, not those trying to lock customers into perpetually expensive solutions. I predict we'll see significant consolidation in this space within 18 to 24 months. The capital requirements to compete effectively are enormous, the technical differentiation is minimal, and the margin pressure is unsustainable for most players. Companies like Lepton, selling to NVIDIA for hundreds of millions, that's the beginning, not the exception. If you're evaluating inference providers for your organization, focus on these 3 criteria. 1, total cost of ownership, including hidden fees. 2, migration flexibility. Can you easily move your models elsewhere? 3, value-added services beyond raw compute power.
Segment 4. The investment thesis reality.
Let's address the billion-dollar question. Are these valuations justified? From a venture capital perspective, inference providers represent a calculated bet on market timing and potential consolidation value. The $106 billion inference market projected for 2025, growing to $255 billion by 2030, creates enormous opportunity. But market size doesn't equal market capture. These companies are competing in a space where the largest players, AWS, Google Cloud, Microsoft Azure, have massive structural advantages. A $1 billion valuation on 40 million revenue implies a 25x revenue multiple. For comparison, established SaaS companies with 80% gross margins trade at 10 to 15x revenue. Either investors are pricing in massive growth and margin expansion, or we're seeing late-cycle venture capital deployment with questionable risk assessment. From my perspective, the sustainable players will be those that either 1. Achieve massive scale quickly, 100x current size. 2. Develop proprietary technology that justifies premium pricing. Or 3. Get acquired by strategic buyers looking to fill infrastructure gaps. The inference provider phenomenon represents both the promise and the peril of AI democratization. The promise: making AI accessible to every developer and startup. The peril: building billion-dollar companies on someone else's infrastructure with razor-thin margins. After 25 plus years in enterprise digital transformation, I've seen this pattern before. The companies that win are rarely the first movers or the highest funded. They're the ones that solve real problems with sustainable economics. In the inference space, that means moving beyond pure GPU rental toward genuine value creation. So where does this leave us? The AI inference gold rush is real, but like many gold rushes, it's the picks and shovels sellers, in this case, the underlying cloud providers and GPU manufacturers, who may capture the most value. For business leaders navigating this landscape, focus on solving real problems, not chasing the latest infrastructure trend. For investors, look beyond the revenue growth headlines to the unit economics underneath. And for the inference providers themselves, your window to build sustainable differentiation is closing fast.
Final thought.
The future of practical artificial intelligence is bright. But let's be honest, building lasting companies takes more than GPUs and venture capital. It takes solving real problems for real people with sustainable business models that don't collapse when the hype cycle fades. And maybe, just maybe, the beating heart of applied AI isn't in Silicon Valley anymore. Maybe it's in the Midwest, where folks still value utility over buzzwords and execution over exits. Until next time, stay curious, stay critical, and remember, in AI, as in life, reality always wins over hype.
If your organization is grappling with AI reliability challenges, or if you're preparing for the next wave of verified AI capabilities, let's connect. At nxtg.ai, we're helping enterprises navigate exactly these transformations, bridging the gap between cutting-edge AI research and practical business implementation. Join our growing network of forward-thinking leaders shaping the future of AI together. Visit nxtg.ai to explore how practical AI can transform your organization's decision-making capabilities.